Let's get onto our closing bell exchange and talk about the impact all of this has on markets. Larry Glazer from Mayflower Advisors, Matthew Cheslock from Virtu Financial, and our own Rick Santelli over at the CME in Chicago, all with us. So Matt, I'll start with you. I mean, pretty encouraging response from markets today. Yes, we're down, but really only fractionally now on the S&P. We've had a decent sort of intraday bounce back.
Yeah, a sizable one. This was really a muted reaction. And the market, if you look at the VIX where it was when this trade tariff war was announced a couple months ago, it was probably closer to 20. We're at 12 now, so we're not seeing any market that's nervous about this, at least in the short term. We've been focused on the U.S. economy for so long. We got some news out of the Fed this week that said, you know what, the U.S. economy is doing well. Unemployment is at historic lows. Maybe we have wage growth. These are all positives for the market, and that's why we've seen this market react the way it has.
Larry, you agree with that?
Look, we are seeing a resumption of volatility in the markets over the last few days, and I think part of this is a reaction to what we're seeing. Look, there's no doubt, if you were expecting a calm and easy summer, you're going to have another thing coming to you, as this market's on pins and needles ahead of the July 6th deadline. But it's a quadruple witch. That's got a big fundamental backdrop. You had lower rates this week, you had lower energy prices, all of which are a net positive for the market, despite all of the talk about headwinds. The consumer remains strong with retail sales. You've got all of these real beneficial issues, but the geopolitical concerns are going to create a buying opportunity for investors who are daring over the next few weeks. And we'll see where the real fireworks are ahead of July 4th.
Rick, having flirted with 3% on the 10-year in the middle of the week, we're back down to close to 2.9. What's the main driver for now for the U.S. bond market?
You know, I think when you listen to what Larry says, and I completely agree, the data's getting better in the U.S. It's deteriorating around the rest of the globe. We're speaking in macro terms, of course. But look at what's going on, Wolf. Our yields on the long end are down on the week. The short end up on the week. Same in Europe. So what's going on is that we have a U.S. economy that's outperforming everybody, and the Fed needs the curve to steepen so they can fit in more rate increases, which would be a good thing. The markets seem like they're okay with them, and the more insurance we can grab, the better we are. But the fact of the matter is, our long end is telling us something. The flattening curve's telling us something, and that is that with the Fed remaining vigilant and, in my opinion, doing a good job under the new stewardship of Jay Powell, continuing the rate increases from Janet Yellen, the short end is going to be firm. But trying to figure out why the long end isn't is critical. Our economy's doing pretty good. Yields should have been higher. Global forces keeping these curves flat is going to be something that's going to affect policy reversal, and it's going to potentially give a window for more horsepower in the equity markets. I'm just not sure how long we could benefit from that dynamic.
Larry, are you saying that if we didn't have this trade dispute with China right now, or everybody else, that the stock market would be racing ahead?
You know, Kelly, look, one of the real concerns that we had all year was that interest rates were moving up very quickly, and we had this generational divide where investors were uncomfortable with what, in the grand scheme of things, is not a significant rate increase, but it's enough to derail housing and maybe slow aspects of the economy. Now, as rates are backing off on the 10-year post-Fed, short-term yields moving up, that yield curve is not necessarily signaling a recession. It is signaling a concern. It is signaling the haves and the have-nots in the global economy, just like Rick said. Right now, we're the haves. Small cap, U.S. domestic is the haves. We want to keep it that way, and I think the Fed's doing a good job. We don't want to fight the Fed, so we want to be very vigilant here and very careful. And trade wars can be inflationary, and they can slow the economy. But I think the fundamental backdrop is really solid. Investors have to focus on earnings, and the tax cuts are the gift that keeps on giving throughout this year. But we're going to need a strong stomach, Kelly.
Matt, it's a summer Friday. There's all sorts of excellent sport that could be distracting people. However, you think volumes are going to pick up into the close?
They are literally cheering in the background.
Yeah, I think we're going to definitely get some volume toward the end of the day. So we're going to be focused over the last half hour or so. We've got a quadruple options expiration plus S&P rebalance. So if you are uncomfortable with any position that you do have on your portfolio, this today and next Friday are some good times to get out of it. So there's no excuse if you miss this market.
All right, guys, thank you all. Happy early Father's Day. Larry Glazer, Matt Cheslock, and Rick Santelli.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.